Okay, so we're going to get started with the next session on banks, shifting from non-banks to banks. And we'll follow the same procedures. When we get to the question and answer, please stand up and announce who you are, where your affiliation is. And I want to turn the floor over to Victoria Ivashina, who's going to tell us about bank runs and interest rates.
All right. Thank you so much, Ross, and thank you to organizers for including the paper. This is joint work with Falk Browning, who's at the Federal Bank of Boston. All right, so we already talked today about revolving lines runs, and it might be helpful for everybody to remember that revolving lines are very common in the economy. Most of the companies out there have a revolving line because it's primarily used for management of working capital. That's the reason why a company would run on a revolving line, because access to funding for their working capital is essential for operation of many companies. But we're going to talk about it from perspective of the bank balance sheet. And specifically, the question we're interested in is about runs on revolving lines. So here I'm plotting for you in red uninsured deposits. So those are runnable liabilities for the bank. And in blue are unused revolving lines. So revolving lines can be withdrawn at any given point in time. And the point here is, of course, to show you that, well, revolving line exposure is quite sizable on the balance sheet of the U.S. banks, and we know also that from 2008 and 2020 when we faced a run. Now, what we want to highlight in this paper is that revolving lines are dependent. The runs on revolving lines are sensitive to interest rates. So we already knew that they are runnable. And interestingly enough, while they ran in 2008, they ran in 2020, they didn't run in 2023. And this is where our point comes in. The interest rates were high, and that was an effect that affected revolving lines. How exactly? Well, revolving lines are actually variable rate debt. And if you don't use a revolving line as a company, then you just pay a small fixed fee. If you use a revolving line, well, then it becomes like any other credit, and it's priced as a base rate. Nowadays, it's SOFR. Earlier, in our sample, in our data, it will be LIBOR, but there is a base rate plus a fixed spread, and it's the base rate, that fluctuation in the base rate, that's what makes this a variable debt. And so deposit runs are independent on interest rates. Deposits are our assets. Whatever interest rate environment is, if I'm uncertain about the health of the bank, I will run on my deposits just to make sure that I get my money back. On revolving lines, if for a company, revolving line is a liability and they have to pay for it, and they pay the amount that they have to pay in interest rate will depend on the interest rate environment. Same idea, just to to put a little bit of structure on it, to highlight for you what exactly are the key assumptions that go into all of this. Let's put aside the term loans. Term loans are credit issued for specific purpose, drawn at inception of the loan. When it's repaid, it's canceled. Revolving line is open until maturity. You can draw, repay as many times as you want. So assume that we're going to put aside term loans, just focus on revolving lines. You get it at time 0, but investment comes around at time 1. And you have a continuous function for thinking about investments, and you're going to use your credit for investment. You're going to pay an interest rate on drawn amount. And for simplicity, let's assume that you don't pay anything if the line remains undrawn. Now, because if you draw precautionary, you have to actually park the cash somewhere. So we're gonna, in this case, let's say that you put it in deposits. You're gonna probably put it in deposits in some other institution, not the bank on which you are running, because you're concerned about the health of the bank. But so there is a gap that originates between what you're gonna earn on that cash that you have to sit because you drew it, not because you had an investment, but because you had a precautionary motive. And the difference between this rate will be essential. Now with probability P, bank goes bust. And whatever you didn't draw, you don't get to invest. So now you're only going to be investing the amounts that you drew for precautionary reasons. That's the basic mechanism, that's the basic little structures that you need to arrive to the points that we're making. And so basically, unless you drew up front, there is with some probability, with probability with probability P, you don't get to invest anything else. And so that gives, and so you can articulate a function where you're trying to optimize with respect to how much you draw up front. And this leads you to a couple of consequences. Some of them are obvious. For example, you're more likely to draw on the line if the bank is more likely to go bust. That makes a lot of sense. The one that is more relevant to us is the one that I'm putting here on the slide, and it's the one that tells you that you are likely to draw for precautionary reasons as a function of the gap that exists between the rates and the probability of the bank going bust. So that's the effect that we're after. And, of course, that should have highlighted for you that this gap between the rates is very, very important. Now, we do a couple of things trying to think through this, but this graph should be helpful. In green, I'm showing you deposit rates, and blue and red, one is a policy rate, and the red is policy rate, and the blue is the interest rate on unused commitments. So you can see how this idea that what you're going to pay on your line tracks the policy rate, whereas what you're going to make on your deposits doesn't. And this idea, of course, been out for a while, and it's very easy to illustrate. So that's the origin of this gap. Now, if they would start, it's conceivable that fraction of the money goes into money market fund, and the statistic indicates that some fraction of the money withdrawn in 2023 went into money market funds that, of course, pay rates that are market rates. However, not everything went into money market funds, and so to the degree that brings the effect down, but it doesn't cancel the effect. As long as some part of the money returns to the banking system, and as importantly, as long as it continues earning the rates that is not connected directly to the rates that they are paying on the loan which they are drawing, that effect will continue going through. All right, so we're going to use, as this paper is empirical, we're going to use the equivalent to the credit registry data. This is US data that comes from the stress testing. So the caveat is that it only covers larger banks. The clean data also starts in 2015. We can't quite regress, just take a time series and regress usage of lines on the interest rates, right? I mean, for starters, there is an obvious problem that interest rates are endogenous. We would need some sort of shocks. We would also need, our data starts in 2015, we also would need environments of low interest rates and high interest rate to test this idea. Moreover, since we are after a precautionary motive, we need context where precautionary motive is plausible. We cannot even just take an entire time series. So this entire thing is very, very hard to operationalize empirically in some intuitive and quick way. So we actually going to have what we think is a clever solution. It comes from a cross-section. And what we're going to be using is the so-called method of regression king design. And we're specifically going to focus on 2020 episode. All right. So what is special about 2020? So here in blue, you can see utilization of revolving lines. And you can see how 2020 is big outliers. There is one quarter that there is a big draw on revolving lines. But importantly, next quarter, it comes down. So this is reassuring to us that there was a precautionary motive in the error. Because if it would be for investment opportunities or anything else, this money would have not been repaid very quickly. It would have been drawn and it would have been sitting there. So this indicates to us that 2020 is a good moment. There is other research besides ours that also thinks about precautionary motive in 2020 and concludes that that's something that was important in 2020. All right. So as far as the methodologies that we're pursuing, the idea is the following. So most of you are familiar with regression discontinuity design, which is the first graph. And there it's typically just a switch. Something switches on your new regime, and that's what allows you to define an effect simply by plugging a dummy interacted with what you're measuring. So for example, in the context of credit, there is a large literature that measures consequences, contractual consequences of violation of covenants. So a violation of covenants is a discontinuity. It shifts control rights from equity to debt, and that allows us to detect economic effects of that. Regression king design is something that is identified from a slope. So there is a shift, but it's not a shift in levels, it's a shift in the way the slope operates. Obviously, I'm not gonna give you a lecture on regression king design here, but so where does it come from? And I hope this will make it very, very clear. So I skipped one detail when I introduced the interest rate. I said to you, it's a variable rate, it's a fixed spread over a base, right? Here I'm putting LIBOR. Well, in reality, after the financial crisis, it also includes floors, LIBOR floors, or SOFR floors at this point. Basically, the interest rate is the base rate, except that a contract will also include the floor. So it can never go below that floor, even if the policy rate continues going down, right? And so that creates a discontinuity where up to the floor, the rate is actually proportional. It's a variable rate. But then once you hit the floor, it's flat. It's a fixed rate. Now, the way it looks in the data, it's like this. I cannot follow the same company, right? Because if you think about, for the same company, the rates don't change that much, right? Because so there would be few observations. So this graph is generated from a cross-section, which is why it doesn't line up on one line. But you can see how this regression discontinuity is right there. You can see it perfectly. So the red line is the one that tells you where you are at the floor, and it's fixed before that, and it's variable proportional to the rate after that. Right, so we're going to use this variation, the fact that there is cross-sectional variation depending on the distance to the floors. Now, there is some commentary in the paper about distance to the floor, but technically, actually, because we are identifying out of this break, it is, unless you believe that everything else aligns, all the other fundamental variables align with this discontinuity in the cross-section, you are basically don't need to justify that the floors are somehow exogenous, right? And so that's the core of the methodology. Now, we're going to estimate, so what we do here is the following. So when you do level estimation, when you do regression discontinuity design, then it's one equation with interaction terms. In this context, you just kind of have to construct your coefficient of interest. And so what I'm showing you here, there are 3 panels. I'm just being transparent. I could have reported you only the top one, but actually there are 3. The bottom 2 are the composition of the interest rate as well as utilization rate. And so those 2 are estimated separately, and then you construct the elasticity, which is what you're trying to estimate. The 3 columns correspond just to different controls, right? And so if, for example, we move from the first column to the last column, the effect varies between close to 13% to close to 8%. What this means is, so let's take the last column, that the estimate tells when the interest rate, policy interest rate, which translates to the interest rate that the companies pay on their loan, goes up by 1 percentage point. The probability of using a revolving line for precautionary reason goes down by 8 percentage points. So that's quite substantial, right? All right, so that's the main result. The only other thing that we do is, actually, if you think about it, what I provided you is a methodology for estimating elasticity of using a revolving line, period. I centered it around a period where there is a precautionary motive, and I'm attributing it to precautionary motive, but actually, there is always some elasticity. And so what we did separately is we tried to sort companies based on those that where precautionary motive is much more clear than in another group. And then based on this separation, we are showing you here that actually there is an incremental effect for the group where we believe that the precautionary motive is much stronger. Specifically here, the column 2 and 4 identify companies that under different criteria are drawing and instantly repaying. So that's that kind of criteria that we use for precautionary motive. All right, so now I'm gonna, in a few minutes that I have left, I'm gonna use it to make a broader point. And specifically what we thought about is that, okay, if the revolving lines, if we think about liquidity management more broadly, of course, one question that was in everybody's mind, especially after 2023, is utilization of run-on deposits. So what we want to do here is combine this idea of runny deposits with likelihood that the revolving lines will be run on as well. We're going to do it in a cross-section. So this is at this point we are detaching ourselves from this very hands-on identification that I showed you for detecting elasticity. Hopefully I convinced you of that idea and we measured that it's economically significant. But we are shifting now into the cross-section. So what I'm going to do is that I'm going to use broad data because now I need a time series, I need cross-section of banks in the data that I was using up until now. There were only large banks. There are some trade-offs. I no longer can measure perfectly revolving lines, but now I have longer period, I have more banks, et cetera, et cetera. All right. So what we did is, I'm about to show you the last graph in this presentation, and this will relate us. We're going to be looking at the cross-section of the banks that relying on the sample, and we're going to look at the relationship of betas for deposits to betas on the revolving lines. Betas as sensitivity to interest rate. Importantly, the higher rate for deposits means runnier. So higher beta for deposits means runny deposits, right? And higher beta for revolving lines, it's lower drawdowns. So they wired in the opposite direction, but the graphs that we find, it looks like this. So the correlations that we find in the cross-section is that they are positively related. So you have banks who have sticky deposits. Those have revolving lines that are very sensitive, that are very insensitive to interest rates, meaning they will run regardless of the interest rate environment. And at the same time, you have banks that have runny deposits. Well, those seem to be dealing with a type of revolving credit that is very sensitive to interest rates, meaning when you're a high interest environment, the revolving line will not run. That means that they offset each other. There is an offsetting element that you observe in the cross-section. If you face runny deposits, it's likely that your revolving lines are sitting tight in the context of high interest rate environment. All right, so the conclusions here, well, first we highlight that the fact that thinking about management of liquidity in a more comprehensive way. Deposits are very important by all means, but revolving lines also constitute an important exposure for the banks. And the point that we're making is that unlike deposits, revolving lines and runs on revolving lines are actually dependent on which interest rate environment you find yourself in. Now that, in our view, has some consequences. Some of them relate to how we think. Maybe there is something we need to think about the way banks operate. For example, the graph that I showed you seems to imply that in a cross-section, banks that depend on the funding that is runny tend to make revolving lines that will stay around in the context of high interest rates. This also might change the way we think about 2023 a little bit, because when deposits were running, given that we were in a high interest rate environment, that actually meant that the revolving line were not running in that context, and that is the case. And finally, one interesting point from here is that historically, typical policy response was to bring down the interest rate in response to a negative economic shock. And what a consequence of our paper is that when you do that, you precipitate a run on the revolving line. Thank you.
Okay. And our first discussant is Emil Verner from MIT.
Okay, thank you so much for inviting me to this great conference to discuss this very interesting paper. So the paper is about credit lines. These are commitments to draw any amount of credit at pre-agreed pricing terms, limit, and maturity. And this is a segment where banks are still dominant, unlike many other forms of lending, as we saw earlier today. So the question the paper asks is, what is the interest sensitivity of credit line drawdowns, and how does this affect usage during a crisis, like, for example, March 2023? So the empirical setting is quite nice. It's this regression kink design utilizing these interest rate floors that basically lets you very credibly identify the elasticity of drawdowns with respect to interest rates. And the findings are that revolving line usage is interest sensitive, and it's especially sensitive actually during normal times. It's somewhat less sensitive during crisis times, but nevertheless sensitive across both episodes. And then taking a step back, across banks, there's this negative correlation between deposit outflows and credit line drawdowns, indicative of some sort of synergies between these two sources of the bank's business. And so the broader implication that the paper draws is that runs on credit lines as opposed to deposits are less likely when interest rates are high. So this is one of the figures that I like from the paper. This shows total committed credit lines for large US banks in the Y14 data. And you see, first of all, these are big numbers, $2 trillion in recent years. And it's also gone up quite a bit since the 2008 crisis related to some of the points that were made this morning. And then you see this big drawdown in Q1 of 2020. So in my discussion, I think this is a very nicely executed paper. I'm not going to kind of nitpick too much on the empirical analysis. I find it quite convincing. Instead, what I'm going to do is I'm going to try to think more generally about the drivers of credit line drawdowns and the history of these episodes. Then I'll think a little bit about why were there no drawdowns in 2020, and I'll think about interest rates and maybe push back and talk about some other factors. And then I'll briefly talk about some financial stability considerations. So if you think about why would a firm want to draw down its credit line? Well, one natural reason is that it has some negative liquidity shock. This could be a financial shock, like there's a freeze in the commercial paper market, it can't roll over, so then it's going to have a credit line set up so that it can weather those types of shocks. It might be a real shock, like a cost shock or a temporary reduction in demand that means it's going to have less cash flow, and so it needs to kind of weather that. And so credit lines here are very valuable. They're mitigating the fall in investment. And we know that this is especially done by larger firms. So in the cross-section of firms, it's mostly big firms that are doing this. A second possibility is that there's a negative shock to bank solvency. And so firms with credit lines might get concerned and draw down precautionarily because they think, well, there's a macro shock, banks are in trouble. I might need that liquidity as well. So let me just kind of try to get ahead of things and get some of this cash now. And then the third possibility is, well, you could have a run or some sort of coordination failure where there's fear because of the fear of others, and you draw down even though you don't necessarily need the liquidity, but just because you want to make sure that you get ahead of others. And so this paper is saying that drawdowns are quantitatively dampened in each of these channels when the interest rate spread, and I'll get back to that point, is high. So then if you think about the supply side, the provision of credit lines, what really matters for the banks is basically what funding conditions are like for the banks when firms are drawing down, right? So what the covariance structure is between the drawdowns and funding conditions. And by funding conditions, I mean basically the cost of deposits and other sources of funding like wholesale funding. So kind of the more benign scenario is if there's a deposit inflow, right? So if, when firms are drawing down, the bank is getting deposits maybe from other sources, then this is really where banks actually have this comparative advantage. These are sort of offsetting each other. There still can be some issues for the bank because its balance sheet is going to expand, and so it might be capital constrained, and that might encumber some new lending, but sort of this is still a relatively benign scenario. The more problematic scenario for the bank is if funding conditions are tightening at the same time. If, for example, there's a deposit outflow because there's solvency concerns and that's raising the cost of wholesale funding and it's reducing large deposits that the bank has, then all of a sudden it's going to have to fund this drawdown with more expensive marginal sources of funding. So that could be borrowing from the interbank market, but in the US it's also very heavily borrowing from the FHLB or ultimately from the discount window. And this is going to be sort of a channel that's going to exacerbate problems for the bank in a crisis. So I tried to sort of take a step back and think about the major drawdown episodes in history, and I was hoping I could just find sort of a Reinhard Rogoff style paper that had this table. I couldn't, so I tried to make my own version. It seems to me one of the first major credit line drawdowns was the failure of Penn Central in 1970, where there's basically a freeze in the commercial paper market, and banks turn to their credit lines, they draw them down, and at the same time banks go to the discount window at the Fed to make sure they can cover that liquidity. At the same time, they're getting these deposit inflows. So the deposits are flowing in. This is sort of a relatively benign situation from the perspective of liquidity provision. The 1987 crash has some of that flavor as well. Russia's default LTCM, similar in that there's stress in capital markets, and so firms are turning to banks to smooth this liquidity shock. 9/11 as well to some extent. And the GFC is really where things are different, where there's basically both concerns about bank health and there's issues in capital markets. And so the banks that are experiencing these big drawdowns, they're also the ones that are actually not getting deposit inflows, and their funding is getting more expensive. So they're getting squeezed on both sides. And that's kind of the really problematic scenario. COVID, you had these massive drawdowns in quantity terms, but they were often precautionary. Firms left the funds within the banking system. Deposits actually go up at the same time. So while there were some problems, capital constraints become more binding, it's not it's not sort of the same type of crisis as 2008, which is sort of the most severe type of episode. And here's just some figures where you kind of see commercial paper, securities markets contracting and credit lines rising at the same time across these different episodes. And so I think the lesson is that the origin of the drawdown really matters. So for example, if it's a firm demand shock, either because there's some problems in securities markets or some cash flow shock, then credit lines are really valuable, right? They're a very useful stabilizer. On the other hand, if there's a shock to bank health, then the credit lines are going to amplify this shock because uninsured depositors are simultaneously going to flow out. And so then, bank is going to be squeezed from both sides. The other thing, if you look at sort of all of these episodes and you read about them, the government backstop really plays a key role. And Nicola was alluding to this morning. This is both from the lender of second last resort, the FHLB, and the lender of last resort. And I think this helps understand a lot why banks still are dominant in this market and are actually expanding in this market. So that brings me to this question of, well, why no drawdowns in 2023? And so the paper talks a lot about high interest rates. And I think the key consideration to have in mind is from the perspective of the firm, if you're going to draw down, well, you're going to pay the credit spread, and then you're going to deposit the funds, say, with the bank or with another bank or maybe in treasuries. And so there's going to be some spread. Here I call it the deposit spread. And the idea in the paper is that the derivative of this carry with respect to the policy rate is negative because the credit spread is going to move, 1 for 1, roughly 1 for 1 with the interest rate, but the deposit spread isn't. So we know, though, in the data that deposit rates for NFCs still have beta is less than 1, but they're higher than for households. I think they're higher than, for example, the picture that you showed. And corporate deposits in the US, there's some evidence from Cooperman et al. That they play close to the safe rate. So this delta carry to the interest rate, it might not always be so far away from zero, though I grant that it is likely to be negative. But it does make me think, are there maybe other stories? Because if you look at these historical episodes, like for example LTCM, the Fed funds rate was above 5%, and there were substantial drawdowns at this time. And so that made me think, well, maybe 2023 is different for other reasons too. Maybe there is just a more limited demand shock for liquidity. Capital markets aren't frozen. Firms aren't experiencing big declines in their sales. There aren't concerns about the health of major banks, at least the ones in your data set, right? The runs that we saw were concentrated in these more regional banks. And there was also this strong policy response at the same time that allayed concerns about kind of banking sector solvency. So My suggestions here would be to provide some more evidence on the deposit rates that different types of corporate borrowers that use credit lines are likely to receive and how those change with interest rates. Then look at the credit lines of the regional banks that are actually subject to funding stress. I know they're not in the Y14 data necessarily, but you can still get a picture of them through the call reports. And then maybe do some kind of mini calibration where you think about your estimated elasticity in sort of a stress scenario and think about, well, how much could this interest rate spread effect offset kind of a general large-scale demand for liquidity. And then finally, let me just say a few things about financial stability implications going forward. So as I kind of alluded to, there's these two perspectives. One, credit lines are really this valuable stabilizer, but on the other hand, they can be an amplifier of risk for banks. And it seems to me that, if you look at these past episodes, the key issues arise when the credit line drawdowns coincide with, solvency crises and fundamental issues for the banks that are exposed to these drawdowns. So we should see kind of the times of risk from credit line drawdowns as being an amplifier of sort of fundamental solvency risk, which I think is the main source of risk we should be concerned with anyway. And one other, I think, just interesting implication of your paper is, in the US, there's been a lot of discussion of this transition from LIBOR, which is a credit risk sensitive measure, to SOFR, which is risk-free. And so, for example, in the 2008 crisis, LIBOR actually increased a bit relative to the policy rate. And your paper is basically showing that because these drawdowns are interest sensitive, these drawdowns that we would see sort of in the next crisis, if risk-free rates come down because they're linked to SOFR, might actually make things even worse. And so that's kind of an implication of this interest rate sensitivity. So thank you very much.
And our next discussant is José Manuel Campa, and thank you.
Thank you. Thank you very much. Good afternoon, everybody. Thank you particularly for the organizers, or to the organizers for inviting me. It's really flattering that you still consider somebody like me to be up to discuss a paper in a research conference, so I'm very flattered by that. And I'm a little bit overwhelmed, but flattered. Anyway, I enjoy very much reading the paper. This is a very, very nice paper. I think it has a very good effort on calculating the elasticity of withdrawal from pre-committed lines to interest rates. I think this is a very obviously relevant topic. I'll make a few comments that this is not a relevant topic just for the US. It's very important also for the EU. In fact, the prevalence of these instruments in the European Union banking sector is just as big as in the US, if not bigger. So I'll make 3 comments on 3 areas. First, I'll make a few comments on the model itself and the estimation strategy, and then I'll make a broader relevance to the topic of the EU, as I mentioned before, and then implications for bank runs and financial stability as the paper does a little bit as well. So let's talk on the model and the estimation strategy. At the end, the model, which is a Mickey Mouse model, a simple model but very illustrative, shows that the reasons for early withdrawal are fundamentally 3. One is the attractiveness of a project that the firm may have to be investing in, and having that liquidity to do that investment is there. Second one is the difference between the price of the committed line and the alternative liquid investment that they can put that liquidity in, and that's the key variable on the interest rate elasticity that we're trying to estimate. And the third one is the probability of default of the bank. Okay. Now, as I said, the relevant price here to me and in the equations is the difference between the price of the committed line and the alternative liquid investment. In the model, there's no alternative source of funding. The firm cannot go and raise fundings for this investment somewhere else, which should be also a relevant opportunity cost, more broadly speaking, in general. Now, the firm, when it holds the cash for precautionary motives, we know it has alternatives. It can put it in a deposit, it can put it in a mutual market fund, it can put it in the same bank, it can put it in different banks. So here, this is simplified by taking the deposit rate, but I think this is crucial to understand well the empirical strategy and the empirical tests, because to me, the empirical strategy, by the way, thank you very much for letting me read the paper. I have no idea what this arcade technique is. I'm not sure I know yet, but at least I know about it, and it's really good. I've made a lot of progress, personal progress. So, but the relevance for the identification here is this kink on the interest rate, and the fact that there's this floor on the interest rate, and they show this nice picture in which there is this floor, and this kink and this floor, but they show that picture on the interest rate that the company has to pay on the withdrawal amounts. They don't show that kink, and to me it's not clear that that kink exists on the real, what I consider to be the real price, which is the difference between that rate and the rate at which the bank the firm will reinvest that money. Particularly to me, given, I'll give you the simple example, you mentioned, Emil, that there's positive betas for corporate deposits. So basically, the corporate deposits don't get paid at zero, but we do know there's a large amount of downward rigidity beyond zero. So it's likely to be that the alternative cost in that pay is clearly kinking around zero. For money market funds, the same thing. I can put in a money market fund if it pays me positive. If it pays me negative, I just put it in a deposit. So it's likely that the alternative also has exactly the same kink at exactly the same place. So when I think about the difference, which is the relevant, I'm not sure that the kink is there. And that's a thing I think that we need to, I would like to be more convinced on that part, Coming back to the relevance of this for the EU economy, I'll just brought some statistics, since this is what we do at the ABA, we collect data. And we write regulation too, but we do collect data. But here what you see is basically, I tried to reproduce the chart that was shown by both Victoria and also by Emil. What you have in the left-hand side, the ratio of loan commitments to share of liabilities. In Europe, is in the range approximately over this period of about 17 to 18%. The chart in the US shows about 16%, so it's basically in the same range of amounts. On the right-hand side is basically the sum of all off-balance sheet commitments of the banks, which is, loan commitments plus financial guarantees plus other commitments. It's a bit larger, obviously, because it includes loan commitments but other stars, but the core of that part is really loan commitments, so that's very large. Now here, what you have is something that I think is important, is also the reaction of this, of the behavior, the change in the behavior of these off-balance sheet items through these episodes. It starts with COVID at the beginning of 2020, the second quarter right after the COVID, how the banks react, and it goes up to the end of 2022 for Europe relevant because that's basically the Russian invasion of the Ukraine. Well, you see there is tremendous policy action around COVID. Supply chain, this is not withdrawals, this is commitments by banks. And what you see, the orange one is the loan commitment. So it's been a huge increase in the second quarter of 2020, by the banks, proactively providing commitments, part of the policy action, because there was a lot of liquidity being provided in that country to try to react to COVID. So I think that that's something that I'm not sure is the same. I assume it's the same in the US. I don't have the figures, but I'm pretty sure because the policy action was essentially the same. So I'm not sure that this is properly captured in the paper. There's this big supply shock at the same time when you're trying to estimate this elasticity. Beyond that, when I think about the COVID episode, the paper uses the data from 2015 to 2022. Does not include the 2023 turmoil. And to me, that's a bit of a paradox, because intuitively, I would think that that's the best episode to try to estimate this, because COVID was an aggregate shock, not a banking-specific shock. It was a shock in which, from my perspective, the other variable, which is the investment opportunities that the firm has, is likely to have changed drastically. There are huge, though at the time, from our perspective, there were huge operational challenges on execution. There were huge demands for liquidity on precautionary basis. That's a good basis. But there are also huge uncertainties about the opportunity cost of the firms. So here, the cross-section, I think, can help you a lot in trying to identify that better, because to me, again, that opportunity cost of the firm in future investments is likely not to be linear as well. It's likely to potentially have kinks. So therefore, I'm not sure that the identification strategy is well. In fact, when you look at the results and you look at the evidence that you show once you account for industry fixed effects, not just time fixed effects, but industry fixed effects, the overall effect and the economic significance of the elasticity drops a lot, which to me signals that there's a lot going on there in the cross-sectoral that has much more to do with volatility of the aspects. If I were now to talk a little bit about financial stability, and this is very, very quickly because I only have 2 minutes, but basically what you have here, what you have there on the left-hand side is the first chart I showed before, is the percentage of loan commitments, undrawn loan commitments. In the EU, unfortunately, we don't have evidence, card data on drawn loan commitments. We have undrawn and the change in undrawn loan commitments, which is a change obviously in drawn and change in supply. So it's a mix. But there you see the variability over time in 2020 and 2023. On the right-hand side, what you have is the behavior of demand deposits, very, very flat. So that correlation between loan commitments and demand deposits is not clear that it's there, at least at the first look like this. I will be a bit careful about making that assumption or making that relationship very, very good. Now, so what's the implication for financial stability? I must say I was a bit, maybe I'm too sensitive being at the EBA, you know, but the first words in the title of the paper are bank runs, which is like, you know, if you watch the movie Inside Out, it's all like, brings all your readings up. Then reading the paper, I'm much more happy because I don't see bank runs anywhere, so it's a relief. But I wonder, you know, is there a run? What's the relationship? What's it putting here really the bank at stress? And that's the part where I think the paper is not clear. And the link is not clear, and I think Emil made that point already very much. It very much depends on what's the correlation between the withdrawals and the evolution of liquidity of the banks. You know, I'll give you an example. I didn't put it here, but we published it in 2023. You know, the contribution of the change in loan commitments and withdrawals in 2020 around COVID to the liquidity coverage ratio of the banks in the European Union was minor, was tiny. That contribution, basically the coverage ratio to affect, because there was huge policy action happening again at the same time. So I will be very careful about that. And you know, where is the liquidity crunch? Where is the correlation between those bank runs and those withdrawals of credit lines at the potential bank run of the financial instability concerns? The abstract says that sudden widespread drawdowns on credit lines can be destabilizing for the banking sector. It could be, but the paper is really about the price elasticity. It's not about this. So let's be careful there. You know, one last point. You know, there is no evidence also of flight to quality, which I would expect that will happen. You know, if I'm withdrawing from a bank for a precautionary reason, because particularly there is a PIA probability of default, I would expect that I will invest the money in some kind of flight to quality. 2020, there's no evidence. It's not really tested. I don't know. Maybe there was. But to me, intuitively, and this will be a key issue, I will encourage the authors to span the sample to 2023. Because the 2023 episode, I think there is, as you said already, first of all, you make conclusions about high interest rates. Well, let's see how sensitive they are to those high interest rates. Second, you know, we know there was deposit shifts. We know there were deposit shifts across U.S. banks to large banks. There was a little bit of flight to quality. It'd be nice to see if that's really is also happening on these credit commitments, you know, if that's evolving over time or not. So let me stop here because I'm out of time. Conclusion, thank you very much for letting me read the paper. It's a very good paper to read. It's a good effort on measuring this interest rate elasticity of precautionary withdrawals, but with more concern about on the paper on conclusions on uninsured versus insured deposits, bank runs, and financial stability concerns. Thanks a lot.
So I think we'll continue with the scenario of taking questions. You can obviously, in answering questions, choose to address some of the remarks by the discussants. And remember, please, to stand up and give your name and affiliation. Please, Kelly. Yes.
Kelly Hsu, Yale. So I found your interest rate channel actually quite intuitive and believable. My suggestion is, in your analysis, to add an additional control variable for a potential complementary explanation, which is, from the corporate perspective, the main alternative to these credit lines is obviously commercial paper. And so the health of the commercial paper market, as well as the rates in that market, really matter. If we compare 2020 and 2023, in 2020, the commercial paper market was just kind of inaccessible. So these firms had to draw on these credit lines. Whereas in 2023, even if you are kind of worried about this bank health, if there's a robust commercial paper market, and those loans tend to be cheaper anyway, so they're higher up in the pecking order, there's kind of no need to draw down on these credit lines. So it's just an additional control variable that could help you clean up the analysis.
I don't know if you want to.
Sure. Thank you, Kelly. Thank you, José Manuel, and thanks, Emil. These are all great suggestions. On the 2023, we cannot use our methodology in 2023 because it's based off binding floors. It has to be a period like 2020 when the floors actually were binding, which is what generates cross-sectional variation. That's what the source of differential exposure. So that's what creates different firms have different interest rates that they have to pay. Now, so it's anchored around 2020. Really, the longer period is there for some additional tests. So would love to do that for 2023, but this methodology is not feasible in a high interest rate environment. There were the comments that concern macro variables, like a general state of the commercial paper market, or, for example, what generally money market funds pay, also would be kind of addressed by this methodology, since the variation is cross-sectional and market variables are fixed for everybody. They all can make the same on the money market funds. So in that sense, the difference matters for the gap, and the gap is preserved because it's universal for the variable against which we are benchmarking, be it commercial paper or money market funds. That's fixed. Now, I'm happy to take more questions. Maybe I'll squeeze other things I wanted to say as other people ask questions.
Please, and then first, yes.
Thank you. Jean-David Sigaud, ECB Research. Very interesting paper. As you explained, the interest rate on these lines, there is the LIBOR, which is variable, and there is a fixed part. But for how long does this fixed part remain fixed? And could it be that banks behave differently in terms of fixed parts depending on the stability of their funding structure? Meaning a bank that has an unstable funding structure with depositors that are flighty would actually make sure that they increase the spread at the time when their depositors fly out, thus creating this correlation between the two betas. Thanks.
It's an interesting idea, but this is a contract, right? So it's a contract with a fixed rate, so until maturity of the contract. So it's not clear what would be the premise under which a bank could trigger negotiation of a contract. So it's I mean, anecdotally, we know that this is a rate that one pays. Earlier, in one of the earlier discussions, presentation, I saw that there was a reference to this Blackstone case, where Blackstone, and this is true for many private equity firms, that they give a mandate throughout their portfolio companies of drawing on the revolving lines, precisely because the rate on which they're going to borrow is honored. It's a rate in the contract.
Between the betas, very intriguing. And I was wondering whether you can elaborate a bit on the interpretation. I thought that one interpretation is that banks actively sort into specific depositors, so banks with more flighty depositors sort, however they do that, into customers that are where the drawdowns are less sensitive. Another interpretation would be that there's actually a negative correlation simply between drawdowns and changes in deposit volumes, because at a customer, I have two sources of liquidity. Either I use my deposits or I draw down my credit line. So if I draw down my credit line more, then for the same bank, the deposits will simply be more stable. So it might not be about the interest rate, but just about the negative correlation between drawdowns of credit lines and deposit volumes.
Let me recognize the fact that we are very focused up front on just kind of articulating the idea, making sure that the assumptions that go into the idea being true are validated, coming out with methodology to estimate elasticity, estimating elasticity. And then after we conquered all that, we put out this big thing where we say, hey, this research that Itamar and Philip and Alex have been done, let's relate this and bring this in this unifying liquidity management. And there is this interesting point that could be consistent with these interpretations that you say. I'll be honest, I didn't think about the second one, where you implying that the companies have sizable deposits in the same banks with which they have relationship on revolving lines. It's an interesting idea, and it's you kind of need to believe that when we see deposit runs, they are big chunk of them tends to be companies that are just drawing on their deposits. I think that this will go back to this point that I hope we articulated clearly, but Emil really nailed it in that what we are envisioning here in this paper is that it is the shock to a bank, right? And so if it's a shock to a bank, then you should, even if you have deposits in the same bank and revolving line, well, you should be withdrawing them both. You had them both for a reason. So that should trigger actually run the both. So the context where for some reason you're withdrawing deposits because you're concerned about something, and yet a revolving line, which funds your working capital, you're like, I don't need that. So that seems like a somewhat contradictory scenario. But agreed that there seems to be more to do in that direction.
So Tobias Berg from Goethe University, Frankfurt. Victoria, you highlight a quite positive effect of higher rates or higher differences between credit line rates and deposit rates. And I was wondering whether there's not an associated negative effect. Because the fact that firms don't draw their credit lines when rates are high means they can't implement their positive NPV projects. So isn't there a certain trade-off between financial stability that you highlighted on the one hand, but efficient capital allocation on the other hand, where we actually want firms to implement as many of the positive NPV projects as possible?
Excellent question. And I'm going to tie it back to José Manuel's criticism about overusing word runs on the bank. And so the key part here is that this is precautionary, right? So it's not about the whole point that we're trying to make is that this is a part where you just draw cash out of the bank and you just sit it in cash in a money market fund or in a different bank, right? So this is really not about investment opportunities, and we try to be very clear about it. This is why we picked that 2020 episode, and by the way, it was very neat to see that the same thing, the same quarter kind of pops out in José Manuel's graph, pops out in the opposite direction because he's plotting the opposite variable, drawn, undrawn, but it's right there, right? And the other thing that I did not mention in my presentation but becomes clear is that one thing that you could think about, oh no, that pop in drawdown was really about investments. And they just refinanced it into something else after the policy intervention, which is why the line comes down. On that front, we actually do work in the paper to make sure that this is not a bridge loan. It's not that they actually invested this and then they refinance it and so it comes down. We actually confirm that this is cash drawn, cash return, one period that they paid just for insurance to have that cash in their pocket. So it's not really about investment. It's run on the banks in the sense that we are after precautionary motive, which is a run on the bank.
I wonder if unless I see another hand, I maybe want to give you sort of a minute just to respond to the question of the implications for bank stability. More that this question of is this a big deal? The fact that they draw down in these periods, like does this cause instability? And if I'm misinterpreting your question, let me know. But I think, and so I wanted you to have sort of yeah.
Look, the graph, the very first graph that I showed you is a red line and deposits, uninsured deposits being a substantial fraction of exposure of the banks. Revolving lines are about half of that. So that's one observation. If I think about episode like 2008, same observation. Revolving lines were not the cost of the financial crisis, but surely didn't help, right? So it's kind of one of those, so banks have runnable exposures that goes beyond deposits. And some of them are quite sizable, and revolving line probably comes in a solid number 2 and in a very large economic magnitude that we looked at. And so with that in mind, this is not really about, this is the only thing. This is one of the domino pieces in a otherwise fragile system. Or perhaps there is something to the banking, the way the banks themselves think about it, that in a way that they do their lending and then the way they fund itself, that actually offset each other at some level. So this is more a call of understanding and potentially an important exposure that could amplify, could make the effect bigger, not necessarily amplified. And something that perhaps we have to think about when we think about bank liquidity management more broadly. So it's not narrowed down only to deposits. There is more pieces, and they clearly taking that into consideration.
May I push I fully agree with what you just said, by the way. And obviously loan commitments and off-balance sheet commitments is a very important part of management of the bank, including for liquidity and mainly for liquidity purposes, as you said. But I just wanted to ask you further a little bit of the issue of the 2023 exercise. Just to make sure I understand the paper. The way I understand the paper, you use the 2020 exercise because you have the possibility that there's this kink, which I understand that, and that gives you the ability to identify the elasticity. But now you have the elasticity. You can do an out-of-sample exercise and try to think about, on the 2023, how well does my model perform, at least, and see if there's patterns there that are aligned with what some of the basic assumptions in your model or not. I will encourage you to do. That's what I meant by doing that, not just estimating on the 2023.
Look, it's a good point. I think that being an academic and aiming at clearing all the big hurdles that we build on ourselves, I was focused on things that I can identify very neatly. But look, I mean, if I'm given the room to speculate, I'd be happy to do that exercise.
Please.
Hi, Rafael Repolo from Senfi. Now, in the light of the huge amount of these credit lines, as you showed in the first picture, and the potential risks for the financial system in terms of these correlated withdrawals of the credit lines, it might make sense from a financial stability purpose to reduce the willingness of banks to grant credit lines by, for example, increasing capital charges on the undrawn part of the credit lines. Do you agree with that?
Clearly not something I'm trying to think about it because it's clearly not something within this context. I'm taking these lines as something that is essential to the firm life and ability to manage working capital, and we have research with that, other papers. There is also an element of, do I see banks taking some sort of risk that have revolving lines gone up so we don't see any of that, right? And revolving lines are typically senior secured, very safe. And the other point, of course, the one that relates to Kashia, Rajan, and Stein, which is the point about fantastic papers that tells us, well, perhaps the reason why the liabilities that are heavy on deposits and assets that are heavy on revolving lines have a synergy because they both have liquidity management. And I think our paper also kind of adds an extra layer to that, and that there is more to this liquidity management that has complexity in it. I think the last graph that I showed to you actually would push back on the arguments I'm articulating. So my take, and I see that Emil wants to say something that I'm eager to hear that. My take is nothing so far indicates me that somehow we need to compress issuance or revolving lines. But you're right in that there is something remarkable about the way that they are priced, and that is that the rate on the revolving lines is pretty standard and pretty flat and insensitive to any kind of credit risk of variation. And so that perhaps is the only hint of that tints my argument.
That's exactly what I was going to say. I mean, the table I showed with all these different episodes and how the correlation basically can flip in really bad crises versus some of these more minor crises shows just like how difficult of an asset pricing problem this is to basically price these puts that these banks are writing. And that's kind of what gives you some pause there. And I don't think we actually really have a good answer for how to do that.
May I just, a very small addition, this is obviously an issue that we discuss with the banks a lot, and they argue that the capital charges may be too high, but there's another segment of the banking sector which is quite relevant, particularly this, which is credit cards for consumers and consumer loans. So, which you have essentially the same problem, which you have undrawn credit lines with the use, and the credit rating there can fluctuate much more and much more difficult. Obviously, the margins there are completely different. The rates at which, but that's more sensitive from the risk perspective.
Quick. Oh, sorry.
Raghu Rajan, University of Chicago. This last conversation, I mean, is part of what's going on that the banks are pricing these extreme situations based on the intervention of the Fed or the central bank? That, okay, if everything comes together, then perhaps it's not so costly because we'll have a systemic issue and then there's liquidity pumped in. Or that they will access those lines which we talked about this morning, that they will access lines of credit from the central bank at that point. And so that pricing or that event is taken care of.
I think it's a great question. It might be true. As I already alluded, I think that there is a little bit, we don't have any work that dives into thinking about variation across banks in liquidity management in the more complex ways and how much they rely on deposits, right? And it seems to me that from what we're showing you here is that there is something else there. And so that could also go in the direction of maybe the pricing of revolvers is flat within the bank, but it is not flat in a cross-section of the banks. Seems like that there is a little bit more to explore before we conclude, but it's a valid hypothesis.
So we have neither exhausted the audience nor the discussants and the speaker, but we have exhausted the time. Thank you.